Preparing for a financial analyst at BT interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a financial analyst do, and how would that role create value at BT? A financial analyst turns operational data into better decisions. At BT, I would connect customer, network, workforce, and commercial drivers to budgets, forecasts, cash flow, and returns. My value would come from identifying variances early, challenging assumptions constructively, and explaining implications clearly to non-finance stakeholders. I would also automate repeatable reporting and protect data quality. Ultimately, the role links financial discipline with BT's priorities: reliable connectivity, efficient investment, sustainable cash generation, and improved shareholder returns. While answering, focus on planning, forecasting, performance analysis, decision support, data quality, and how finance can improve returns from BT's network investment, customer economics, cost base, and transformation agenda. Question 2. Why do you want to work as a financial analyst at BT? BT appeals to me because it combines a large, essential infrastructure business with a demanding transformation agenda. The analyst role would let me work where financial decisions have operational consequences, from fiber rollout and network efficiency to customer retention and cost control. I enjoy turning complex information into practical recommendations, and BT offers genuine scale and learning opportunities. I would be motivated by helping management allocate capital carefully while improving performance and service for customers. Make sure to cover BT's scale, telecom infrastructure, long-term investment requirements, transformation, customer impact, and why your analytical, commercial, and communication skills fit the role. Question 3. Walk me through how the income statement, balance sheet, and cash flow statement connect. The income statement shows revenue, costs, and profit over a period. Net income then feeds retained earnings on the balance sheet, while the cash flow statement adjusts profit for non-cash items and changes in working capital. Capital expenditure increases assets and reduces investing cash flow, while depreciation lowers profit without an immediate cash outflow. At BT, linking the statements helps distinguish reported earnings from underlying cash available for network investment, debt service, and dividends. In your answer, talk about profit generation, balance sheet movements, non-cash items, working capital, capital expenditure, financing, and the importance of reconciling accounting performance with cash at BT. Question 4. Which key performance indicators would you monitor for BT? I would monitor revenue growth by segment, customer additions, churn, average revenue per user, EBITDA margin, operating cost per customer, capital expenditure, and free cash flow. I would supplement financial KPIs with network availability, fault resolution, fiber penetration, and customer satisfaction. The key is interpreting relationships. Strong connections growth with weak cash conversion may indicate heavy investment, while revenue growth alongside rising churn could signal poor customer economics. I would always compare results with guidance and prior periods. Be sure to mention revenue growth, average revenue per user, customer additions and churn, EBITDA, operating costs, capital intensity, free cash flow, service quality, and segment-specific interpretation. Question 5. How would you investigate an unfavorable variance in BT's monthly results? I would first confirm the variance is real by checking source data, accounting treatment, and the comparison basis. Then I would decompose it into price, volume, mix, timing, foreign exchange, and one-off effects. For example, an energy cost overspend might reflect consumption, tariffs, or delayed accruals. I would discuss the operational cause with the budget owner, assess whether the forecast needs updating, document an action plan, and monitor whether the issue reverses or becomes structural. While answering, focus on validating the data, quantifying the variance, separating price, volume, mix, timing, and productivity effects, engaging owners, and agreeing corrective actions with clear follow-up. Question 6. How would you build a forecast for BT's revenue and costs? I would build the forecast from operational drivers rather than simply applying a growth rate. Revenue could reflect customer numbers, churn, product mix, pricing, and average revenue per user. Costs would incorporate headcount, supplier contracts, network usage, energy, inflation, and transformation savings. I would validate assumptions with commercial and operational teams, include seasonality, and produce base, upside, and downside cases. Finally, I would compare forecast accuracy over time and clearly highlight the assumptions carrying the greatest risk. In your answer, talk about driver-based modeling, historical trends, operational inputs, assumptions, seasonality, scenarios, sensitivity analysis, validation, and communicating forecast risks rather than presenting false precision. Question 7. How would you assess whether a BT network investment is financially attractive? I would assess the investment using incremental cash flows, not allocated historical costs. Those cash flows would include rollout capital, maintenance, additional revenue, avoided operating costs, taxes, working capital, and any terminal value. I would calculate NPV using an appropriate discount rate, review IRR and payback, and test adoption, pricing, costs, delays, and useful life. I would also consider strategic benefits such as retention and network resilience, while distinguishing quantified benefits from qualitative judgment. Make sure to cover incremental cash flows, capital expenditure, customer benefits, operating savings, useful life, NPV, IRR, payback, risks, scenarios, and strategic benefits that may not be captured fully in one metric. Question 8. What is free cash flow, and why is it important for BT? Free cash flow is the cash generated after operating needs and capital expenditure, commonly calculated as operating cash flow less capital investment, with the exact definition depending on reporting policy. It matters at BT because the business must fund fiber and network upgrades while meeting debt service, pension, dividend, and liquidity requirements. I would analyze both the amount and quality of cash flow, separating recurring generation from working capital timing, disposals, or other exceptional items. Be sure to mention operating cash flow, capital expenditure, working capital, taxes, cash conversion, funding flexibility, debt obligations, and why capital-intensive telecom businesses must balance investment with financial resilience. Question 9. Explain how you would use NPV and IRR when evaluating a BT project. NPV discounts a project's expected incremental cash flows and subtracts the initial investment. A positive NPV indicates value creation at the chosen discount rate. IRR is the discount rate that makes NPV equal 0. I would prioritize NPV for mutually exclusive projects because it measures absolute value, while using IRR as a supporting return indicator. I would also test sensitivities, avoid mixing nominal and real assumptions, and consider whether timing, scale, or non-financial benefits distort the comparison. In your answer, talk about discounted cash flows, time value of money, mutually exclusive projects, reinvestment assumptions, discount rate consistency, scale differences, and using both metrics alongside strategic and risk analysis. Question 10. How would working capital affect BT's cash flow forecast? Working capital affects cash flow through the timing difference between recognizing revenue or costs and collecting or paying cash. I would forecast receivables using billing patterns, customer mix, collections, and bad debt assumptions, payables using supplier terms and expenditure timing, and accruals using operational activity. I would investigate unusual movements rather than assuming every change persists. At BT, even modest improvements in collections or supplier terms can release significant cash because of the company's scale. While answering, focus on receivables, payables, inventory, contract timing, billing cycles, accrued costs, seasonality, cash conversion, and distinguishing sustainable improvements from temporary movements. Question 11. How would you build a downside scenario for BT? I would start with specific risks rather than applying an arbitrary percentage reduction. A downside might combine higher churn, weaker customer additions, slower fiber adoption, inflationary supplier costs, delayed transformation savings, and rollout delays. I would model the impact on revenue, EBITDA, capital expenditure, free cash flow, leverage, and liquidity, then identify management mitigations such as phasing investment or reducing discretionary costs. I would present sensitivities clearly, explain the assumptions, and distinguish a plausible downside from an extreme stress case. Make sure to cover realistic operating drivers, downside assumptions, revenue pressure, churn, inflation, project delays, liquidity, management actions, probability or sensitivity analysis, and transparent communication of uncertainty. Question 12. Which Excel techniques would you use most frequently in a BT financial analyst role? I would use SUMIFs, XLOOKUP or index match, pivot tables, structured tables, conditional formatting, and scenario controls regularly. For recurring data, Power Query could standardize imports and reduce manual errors. I would separate inputs, calculations, and outputs, include reconciliation checks, and avoid hard-coding assumptions inside formulas. For management reporting, I would pair concise charts with driver commentary. Excel is powerful, but I would focus equally on model transparency, version control, and making outputs easy to challenge. In your answer, talk about pivot tables, XLOOKUP or index match, SUMIFs, scenario controls, error checks, data validation, charts, Power Query, and building transparent, auditable models. Question 13. What steps would you take to ensure the accuracy of a financial report? I would begin by confirming the source systems, reporting period, definitions, and ownership of each data field. Then I would reconcile totals to the general ledger or approved operational reports, test formulas, review cutoff, and investigate unexpected movements against prior periods and forecasts. I would use independent reasonableness checks, retain review evidence, and control file versions. If a difference remained unexplained, I would escalate it before reporting rather than adjusting it informally to make the numbers balance. Be sure to mention source reconciliation, control totals, reasonableness checks, period cutoff, variance analysis, review evidence, version control, segregation of duties, and escalating unexplained differences promptly. Question 14. How does International Financial Reporting Standards 16 affect the analysis of BT's financial performance? International Financial Reporting Standards 16 generally brings leases onto the balance sheet through a right-of-use asset and lease liability. Instead of recognizing a straight-line operating lease expense, the company records depreciation and interest, which typically increases EBITDA but still affects profit and cash flow differently over time. For BT, I would understand the lease portfolio, reconcile reported and adjusted measures, and avoid comparing periods or peers without consistent treatment. I would also consider leverage and covenant definitions carefully. While answering, focus on lease recognition, right-of-use assets, lease liabilities, depreciation, interest, EBITDA effects, cash flow presentation, adjusted metrics, and comparing companies consistently. Question 15. What revenue recognition issues might arise in a telecommunications business such as BT? Telecom contracts often bundle connectivity, equipment, installation, and support, so the analyst must understand separate performance obligations and when control transfers. Revenue may be recognized upfront for delivered equipment, over time for service, or as usage occurs, depending on the contract. I would review discounts, contract modifications, activation fees, contract assets, and deferred revenue, then reconcile billing data to accounting results. The commercial structure matters because reported revenue timing can differ from cash collection materially. Make sure to cover bundled products, performance obligations, handset or equipment components, contract modifications, discounts, activation fees, usage revenue, contract assets, and applying International Financial Reporting Standards 15 consistently. Question 16. How would you analyze a proposed cost reduction initiative at BT? I would establish a credible baseline and separate recurring savings from temporary reductions. The analysis would include implementation costs, timing, headcount or supplier impacts, cash versus accounting benefits, and any reinvestment required. I would challenge whether savings are incremental or already embedded in the forecast, and test effects on customer service, network reliability, and employee capacity. After approval, I would assign owners, define measurable milestones, and track realized benefits monthly against the original business case. In your answer, talk about baseline costs, one-off implementation costs, recurring savings, timing, service quality, workforce impacts, double counting, ownership, and tracking realized benefits against the business case. Question 17. Tell me about a time you had to explain complex financial analysis to a non-finance stakeholder. In a previous project, I explained a forecast shortfall to an operations manager who did not work with finance terminology. I began with the decision required, then used a simple bridge showing customer volume, pricing, supplier costs, and timing. I avoided accounting jargon and translated each variance into an operational action. I invited the manager to challenge assumptions, corrected one data issue they identified, and agreed follow-up ownership. That approach produced a more accurate forecast and stronger collaboration. Be sure to mention simplifying the message, starting with the decision required, using relevant drivers, avoiding jargon, checking understanding, listening to challenge, and adapting detail for the audience. Question 18. What would you include in a monthly management dashboard for BT? I would design the dashboard around decisions, not simply available data. It would include revenue, EBITDA, operating costs, capital expenditure, free cash flow, customer and network indicators, and progress against transformation targets. Each metric would show actual versus budget, prior year, latest forecast, trend, and owner commentary. I would use a concise executive page supported by drill-down detail, highlight exceptions with clear thresholds, and ensure definitions remain consistent so management can distinguish performance changes from reporting changes. In your answer, talk about decision-relevant KPIs, actual versus budget and forecast views, trends, variance drivers, cash and capital measures, operational indicators, concise commentary, and clear escalation thresholds. Question 19. How would you decide whether BT should outsource a finance or operational activity? I would compare the full lifecycle cost of insourcing and outsourcing, including transition, technology, management, redundancy, and contract costs. Financial savings alone would not decide the case. I would assess service quality, resilience, data security, control requirements, scalability, and whether the activity is strategically important. I would model different volumes and supplier outcomes, review exit provisions, and define service level metrics. The recommendation should show risks, mitigations, and a realistic payback rather than headline savings. While answering, focus on total cost, service quality, control environment, resilience, strategic capability, transition costs, contract risk, data security, scalability, and measurable benefits over the full lifecycle. Question 20. If BT's revenue missed budget but free cash flow exceeded expectations, how would you explain the result? I would reconcile the result rather than assuming it was positive operational performance. Revenue may have missed because of weaker volume or delayed installations, while cash flow could benefit from improved collections, delayed capital expenditure, supplier timing, or one-off receipts. I would bridge budget to actual across EBITDA, working capital, tax, capital expenditure, and exceptional items, then assess sustainability. If cash out performance was timing related, I would not raise the forecast without evidence. I would flag the likely reversal and underlying commercial weakness. Make sure to cover revenue drivers, EBITDA conversion, working capital timing, capital expenditure phasing, one-offs, cash quality, forecast implications, and avoiding conclusions before reconciling all movements. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.